When people compare real estate investing and stock investing, they often do so from a place of identity rather than analysis. Some proudly call themselves property people, trusting bricks and land over numbers on a screen. Others believe stocks are the only rational path, viewing real estate as slow, illiquid, and operationally painful. Both sides are usually defending personal experience more than objective truth. In reality, real estate and stocks are not rivals fighting for supremacy. They are fundamentally different tools, each with strengths, weaknesses, and behavioral consequences that shape outcomes far more than headline returns ever will. At the highest level, the difference between real estate and stocks begins with ownership experience. Stocks represent fractional ownership in businesses that are run by others. You are a passive owner, delegating execution to management and accepting market pricing every second the exchange is open. Real estate, by contrast, is direct ownership of a physical asset. Even when property is managed by someone else, the investor remains closer to operational reality. This difference matters because it determines where control effort and responsibility sit, and many people underestimate how much that alignment affects long-term satisfaction and discipline. From a return composition perspective, stocks and real estate generate value differently. Stock returns primarily come from earnings, growth dividends, and changes in valuation multiples. Real estate returns are driven by rental income, property appreciation, leverage, and tax. Advantages. Stocks tend to benefit more directly from productivity gains and innovation, while real estate benefits from population growth, location scarcity, and inflation over long periods. Neither asset class has a monopoly on wealth creation. They simply monetize different economic forces. Liquidity is one of the most obvious contrasts. Stocks are highly liquid. You can buy or sell in seconds at transparent prices. This liquidity is a double-edged sword. It provides flexibility, but it also exposes investors to constant emotional temptation. Every price tick invites reaction. Real estate is illiquid. Transactions are slow, costly, and opaque. While this limits flexibility, it also acts as a behavioral shield. Many real estate investors benefit not because properties outperform, but because the friction prevents impulsive decisions that stock investors often regret. Leverage plays a very different role in each market. Real estate naturally accommodates leverage through mortgages, often at fixed rates and long maturities. This leverage amplifies returns, but also risk in ways that feel manageable because payments are predictable and assets are tangible. In stock investing, leverage is optional and often discouraged for long-term investors because margin calls can force liquidation at the worst possible time. The presence of friendly leverage is one reason real estate feels powerful, but it is also the reason mistakes can become catastrophic when cash flow assumptions fail. Cash flow is another area where perceptions diverge. Real estate is often praised for producing steady income through rent. Stocks are often viewed as growth vehicles, with income as a secondary feature through dividends. In practice, both can provide income, but with different characteristics. Rental income is operationally dependent and exposed to vacancies, maintenance, and regulation. Dividend income is dependent on corporate profitability and policy decisions. The stability of either depends less on the asset class and more on asset selection and structure. Risk is frequently misunderstood in this comparison. Stock investors see volatility daily, which makes risk feel immediate. Real estate investors see volatility infrequently, which makes risk feel distant. But risk exists in both. Stocks expose investors to market repricing and business disruption. Real estate exposes investors to concentration risk, local economic shifts, regulatory changes, and financing risk. The difference is not how much risk exists, but how visible it is and how it affects behavior. Visibility often feels like danger, even when it is not. Tax treatment is often cited as a major advantage of real estate. Depreciation expense deductions and favorable capital gains treatment can enhance after-tax returns. Stocks benefit from long-term capital gains and qualified dividends, but offer fewer levers for tax engineering at the individual level. However, tax advantages should be viewed as modifiers, not foundations. A bad investment does not become good because it is tax efficient. Taxes amplify outcomes. They do not create them. Diversification is another key contrast. A stock portfolio can be diversified across thousands of companies, sectors, and countries with minimal capital. Real estate diversification is harder. Individual properties are large, concentrated bets tied to specific locations and tenant profiles. This concentration can work well when conditions are favorable, but it increases vulnerability to localized shocks. Many real estate investors unknowingly carry far more concentration risk than they would ever accept in a stock portfolio. Behaviorally, each asset class attracts different personalities. Stock investing tests patience in the face of volatility and noise. Real estate tests patience in the face of friction and operational issues. Neither is easier. They are difficult in different ways. The best choice is often the one whose difficulties you are better equipped to tolerate consistently over decades. The most important mistake in comparing real estate and stocks is assuming you must choose one exclusively. For many investors, the optimal answer is not either-or, but both sized and structured according to goals, skills, and temperament. Stocks provide scalability, liquidity, and global exposure. Real estate provides tangible income, inflation, sensitivity, and leverage. Together, they can complement each other in powerful ways. Ultimately, the real question is not which asset class is superior in theory, but which one fits your life constraints and psychological makeup in practice. Because an investment that you can hold, manage, and stick with through adversity will almost always outperform a theoretically better investment that you abandon under pressure, and understanding how to make that choice deliberately, how to weigh the trade-offs honestly, and how to decide when one asset class deserves more emphasis than the other is exactly where we need to go next, by examining how these differences play out across risk-return effort and behavior over the long term. Which brings us directly to the next part, where we will continue by looking at how these differences actually play out over time in terms of outcomes, effort, and behavior, because the long-term winner between real estate and stocks is rarely decided by spreadsheets alone. From a risk-return perspective, stocks have historically delivered higher average returns over long periods, driven by global economic growth, productivity gains, and reinvested profits. But those returns arrive unevenly through volatility that tests patience relentlessly. Real estate returns tend to look smoother on paper, partly because pricing is infrequent and opaque, but also because income and leverage mask fluctuations. This does not mean real estate is less risky. It means risk is revealed differently, and often later when adjustment is harder. Capital requirements shape the journey from the very beginning. Stocks allow gradual entry. You can start small, add consistently, diversify widely, and scale exposure as income grows. Real estate typically requires larger upfront commitments, concentrated bets, and access to financing. This barrier filters participants. Those who enter real estate are often forced into fewer, bigger decisions, which can accelerate wealth when things go right, but magnify consequences when they do not. Stocks forgive small mistakes. Real estate punishes large ones. Over long horizons, behavior becomes the decisive factor. Stock investors struggle most during drawdowns and manias. The ease of buying and selling becomes a liability when emotions spike. Real estate investors struggle most during prolonged operational stress, vacancies repairs, regulatory changes, or refinancing risk. The inability to exit quickly can feel stabilizing in good times and suffocating in bad ones. The question is not which stress is smaller, but which stress you can endure without abandoning the plan. Effort and scalability also diverge. Stock portfolios scale effortlessly. $10,000 and $10 million can be invested with similar effort using the same structure. Real estate does not scale so cleanly. More properties mean more decisions, more management, complexity, and often more leverage. Some investors thrive in this environment, turning effort into edge. Others burn out, discovering that returns came at the cost of time, focus, and peace of mind. There is no universal answer here, only personal fit. Inflation sensitivity is often cited as a decisive advantage for real estate, and there is truth to it. Rents and property values tend to adjust upward over time, while fixed-rate debt becomes easier to service in real terms. Stocks also provide inflation protection, but indirectly through companies that can raise prices and grow earnings. When inflation is moderate and growth-driven stocks often adapt well. When inflation is high and supply-driven real estate may feel more tangible. Again, regimes matter more than labels. Then, the most resilient long-term strategies often combine both asset classes deliberately. Stocks provide liquidity diversification and global exposure. Real estate provides income leverage and local scarcity. Together, they balance each other's weaknesses. Liquidity from stocks can support real estate during stress. Income from real estate can reduce the need to sell stocks during market downturns. This integration works best when each asset is sized realistically and managed for its role, not idolized for its narrative. In the end, the real comparison between real estate and stocks is not about which one makes more money in theory. It is about which one you can stick with through boredom, stress, and adversity. An asset class you abandon at the wrong time is inferior to one you hold imperfectly, but consistently. Long-term wealth is built less by choosing the best asset, and more by choosing an approach aligned with your temperament constraints and willingness to stay engaged. If this comparison helped clarify how real estate and stocks fit into your own thinking, consider subscribing to stay with these long-form conversations focused on alignment over ideology, and leave a comment sharing which aspects of investing you find hardest to live with emotionally, because that answer often points more clearly to the right asset mix than any historical return chart ever could.